So you're more prepared that way. So I think one thing I want to tell you guys is that finance is not kind of a specialization. It's like a lifestyle. So you have to like eat, breathe, sleep finance pretty much if you take it. So then if you do that, then you can excel in it, and there is really no limit to what you can achieve. So having said that, so remember, we've looked at what stock markets are, what our investing options are, and we've learned a very important technique in fundamental analysis. Now, fundamental analysis always comes first. Even when you're analyzing technicals, look at applying technicals to something which you have analyzed fundamentally, like earnings, yield, etc. Only when you agree on buying something fundamentally should you apply technical analysis to identify entry and exit points. Okay, so that you must be very clear on. Now, so there are some fundamental, you know, assumptions that technical analysis makes, and rightfully so. So as I showed you in the first session, prices are determined by supply and demand, right? When there are more sellers, prices go down. When there are more buyers than sellers, prices go up. So that is the key assumption behind technical analysis. The market discount everything. Okay, mostly technical analysis works, right, on the presumption that the market knows everything, right? All bits of news, whether it is employment report or profitability report, earnings reports from companies, the market kind of discounts it, meaning the pricing is already reflective of that. Third point is that the market will move in a trend, either in an uptrend or in a downtrend. Okay. Then history repeats itself. Sometimes what happened before happens now. You know, inflationary shocks happened in the early 70s. They are happening now. It can happen, right? Recessions can happen. Yes. Governments can change. So a lot of things, history repeats itself. They say that history may not exactly repeat itself, but it does rhyme. Okay. So that is these are some key assumptions. Okay. So who was the founder of technical analysis? So there was a gentleman by name Charles Dow. Today the Dow Jones average and everything are named after him. So basically, right, so he came up with this idea that past prices can be useful in forecasting future prices. That was the basis for technical analysis. And this came about as early as 1884. And in the early 1920s, technical analysis really started to emerge. Okay. Okay. So what are the assumptions behind Charles Dow's explanation of technical analysis? Okay, so according to Dow theory, it's very, very simple. Yes. So no single individual or buyer can influence any major trend in the market. Though in India, every now and then you hear of scams where individuals like Harshad Mehta, Ketan Parikh have influenced the trend. But in a normal market, this should not happen, right? Individual buyers or sellers cannot influence the direction of the market. That is one. The second hypothesis is the market discounts everything. We talked about that earlier on. The market knows everything. Yes. Yes. Then the third hypothesis, the theory is not infallible, meaning there will always be exceptions to the rule every now and then. Yes. So, so in Dow theory basically takes the overall market trend and divides it into three categories. So primary trend, that is the dominant trend. It can be either up or down. Intermediate secondary trend is movement within the primary trend. So if the primary trend is up, there may be 1 or 2 days when the market goes down. So that will be secondary. And then the short term or minor trend is essentially your intraday action and your small price movements within the secondary trend. But you should always keep an eye on the dominant primary trend. Okay. So you all know this. You've heard of bull and bear market, students? Yes? Yeah. So in a bull market, the primary trend is clearly up. Yes? So let's see if I can draw that, how the bull market looks. Line. Okay. Um, okay. So in a bull market, the trend is up. We have clear-cut peaks making higher highs and higher lows. Okay. So let's see if I can get that finally. So it'll be something like this. Ah, never mind. So I guess never mind. You get the picture. I was just going to draw higher highs and higher lows, but it for some reason is not coming. Okay. So in a bull market, you will have, I will show you later on some real instances where you can understand this better. So we are going to see a series of higher highs and higher lows. Basically, if the trend is up, see higher highs and higher lows. In the bear market, we see lower highs and lower lows. Okay. All right. So um, the goal of technical analysis is basically to stay within the trend. Yes. And not just look at price, but also look at volume. So in a bull market, prices will be increasing with increasing volume. Okay. In a bear market, prices will be decreasing with an increasing volume. So price and volume are also, volume is also a very, very important aspect of technical analysis. Now have a look. Now, here is an example of why you should not do technical analysis alone. Look at this beautiful higher high chart of Idea Vodafone. But look at the PE ratio there. Do you see it, students? What is the PE ratio there? Nearly 46. So if you, technical analysis was asking you to buy the stock, but fundamentally there was no reason to buy as the PE is way overvalued. If you do your earnings yield calculation, this would have been resulted in negative numbers. So this was an avoid stock. So this is the reason why fundamental analysis comes. Look at that. What is the price you see there, students? Nearly 159. Yeah. Where is Idea's price today? Yes, students? Any one of you? Single digits, right? Yeah. 11. Yeah. So it has crashed 90% from these levels. So this is why I said always, always pay attention to fundamentals like the PE ratio first. So the PE ratio is way above 25, way overvalued. And guess what happened to Idea? Trouble was coming if you listen to it. So fundamentally, I would never have touched this stock, but technically it is making higher highs, higher highs. And this was just before it crashed, kept crashing. Okay. All right. But you do see the higher highs there, do you? All of you see the higher highs there? Higher high here, higher high here, higher high here, higher high here, higher high. So technical analysis told you to buy, but fundamental analysis told you to avoid. Always listen to fundamentals first. Okay. Technical analysis is only for the short term to identify entry or exit. Okay. So the bear market trend is the reverse. You're going to make lower highs and lower lows. So bear market will show a clear decline. Yes. Now, this is another reason for you why you just don't look at the graph. Look at the second part of the graph where SBI is making lower lows. But look at the PE ratio. Here on the figure, single digit PE. So technicals told you to sell, but fundamentals told you to buy. In fact, the stock had issued a bonus. So you should compare today's price to 158. That stock has almost tripled because the PE was single digit, right? Yeah. So even though at the short term it was going down, yeah, long term fundamentals told you to buy. That is why I always tell you fundamentals come before technicals. Unless there is a fundamental reason to buy something, don't buy it. Yes, the graph can lead you only so far in the short run, but always have a fundamental reason to buy. Students, any questions on these two things, on these charts? But anyway, it illustrates Dow theory. Higher highs, in this case, lower highs and lower lows, particularly in the second half of the graph. First half, it was making higher highs, but the second half, if you look, series of lower highs and lower lows. Students, you got the concept of technical analysis before we go further into it? Okay, so in a bear market, okay, did you not understand bull market or bear market? Which one should I explain? Should I explain both again? Okay, will do. So in a bull market, you will have higher highs and higher lows. If you see this, there's a high here, higher high, next high. The next major peak is even higher. So the peaks are higher and the bottoms, the troughs are also higher. Do you see that? Yes. This is the sign of a bull market. Higher highs, higher lows. Okay. Whereas in a bear market, look at the second half of the graph. The peaks are lower than the previous peaks for the most part. And the troughs are also lower than the previous troughs. Yes, students? Do you see that? Yeah, great. So that's what I want you to see. Okay, secondary trend is just a reversal. Oh, repeat about the PE ratio. Okay. Great. So even though according to technical analysis, this is a bullish graph, right? But look at the PE ratio. PE is about 25. If you take, remember, if you do this earnings yield calculation, PE 46, 1 by 46 into 100 is 2%. If you subtract the inflation figures from it, it is negative and lower than the risk-free rate. So this was a stock not advisable to buy, even though technicals are telling you have to buy, right? Yesterday you did earnings yield calculations, right, students? So if you apply that, fundamentally this was not a good investment, though technically it looks good. So long-term fundamentals will always work better than technicals is the point I was trying to make. Is that clear? No, you have to compare the 1 by P ratio would give you the earnings yield. You have to add the dividend yield also to it. In this case, it was very less. And you subtract the rate of inflation from that. You compare that to the risk-free rate. At that time, the risk-free rate was around about even higher, 7-8% it was. So fundamentally, this was not a good investment. Though technically the graph was saying, remember, fundamentals first always. Yes? In the same way, if you look at the next one, the same way, if you look at the next graph, the fundamentals are very bullish. Look at the earnings yield on a 6P stock. It's almost 15, plus good dividend yield of 1.5 to, 2 to 3%. So 18 was the earnings yield for SBI. But the technicals were telling to sell. So always go with the fundamentals first. So this was a buy and not a sell. But based on technicals, it was a sell. Yes, students. Is that clear? Yeah. Okay, great. Okay, so the secondary trend usually corrects some of the primary trend. So within the primary trend, you can have down days like yesterday, right? Today again the market went up, but yesterday was probably a part of a, I wouldn't say yesterday was a secondary trend because the trend has been up, but last week was the secondary trend. Overall trend is up, but last week was down. Now yesterday was probably a minor trend. Okay, so a secondary trend can retrace almost 1/3 to 2/3 of the primary trend. Yes, that is just what happens every now and then. The market never goes one way all the way, right? Retracements do happen. So compared to the second primary trend, which lasts for a long time, secondary trend doesn't last. Maybe 1 week, like last week market was down, again now it has resumed up, much up, right? So primary trend, I'm talking about the Nifty by the way. So minor trends are just this intraday price movement or the daily movement, and they are within the secondary trend. Okay, now we will look at patterns and graph. Okay, so one of the things in technical analysis is prices are influenced by uh, supply and demand. We said that, right? So have a look here. There are some patterns which we can look at: support and resistance. What is support? So in that graph, you can clearly see, we will maximize it. Yeah. So what do you see? So you see the price hit a channel here. Yes. And then go up. So that is support. Now what happens after some time? That support breaks. Okay. And prices go down. Now, after some time, the previous support will act as resistance. So resistance is a price, is a level that the price cannot usually cross easily. Support is a price which you can think of resistance as the ceiling and support as the floor. Okay. So have a look. So once support breaks, it goes down. And then once that support is reclaimed, the support acts as resistance. Once we break resistance, we go out again. We go up again. Yes. So is that clear? Yeah. The figure you can see. So resistance, if you look, the top graph, it breaks through that first line, right? That first line, when it breaks through, now it will act as resistance. So price comes down, rebounds, but it cannot cross that top line, right? So the top line is resistance there. But it comes all the way down, and when it bounces up from that bottom line is support. So it is in a channel for some time, but that bottom line breaks and it now becomes resistance. But once resistance is crossed, it now becomes support again and prices go up after this. So support and resistance levels are very, very, very important to look at in the market. We will look at some actual examples with the price movement and stuff, and you will understand better. Students, do ask me questions in between posts. Do post in the chat if you have any queries. Okay. Next, we will look at some indicators. Volume of trade. Remember, I was telling you both price and volume, yes, are very, very useful. So if price is going up and volume is going up also, that's a good sign. However, if price is going up and volume is going up, volume is going down, that's not a good sign. That means whenever price is going up, there are more sellers. Many people are interested in selling. Usually, after a sustained up move, if volume starts coming down, that's a sign to look for a reversal. The trend may change. Yes? Yeah. Similarly, when the market is falling, if it is falling at a high volume, then bear trend is likely to continue. Okay, next we look at something called breadth of the market. So what is the breadth of the market? So breadth is just the number of shares rising minus the number of shares falling. Okay, so breadth has to be positive. If the market is going up and more shares are rising than falling, breadth is positive. That's a good sign. However, if the market is going up and only few shares are going up, market breadth is negative, then probably the trend could change. Okay. Short selling. Anybody know what short selling is? What is it, students? So basically, you are selling before you buy. Yeah, so selling without owning the shares is what it is. But can you sell without owning the shares? How can you do it? Yeah?
Yes, sir. Saying short selling, you don't need to have the securities with you. You can just directly dump in the market in the opposite way. Like when you are placing the buy order, instead of that, we go for the sell order. And it's a legal thing, and it is the thing which is accepted by NSE and BSE. So we can do it.
But you can only do it in the cash market intraday.
Yes, sir, exactly.
Why is that?
Sir, because by the end of the day, there is a settlement, sir.
No, but why we should not keep it for the next day? Yeah. So the
Sir,
point is SEBI doesn't allow short selling. Technically, they don't allow you to carry over positions, which is a very silly thing, I think. Okay. So, but you can do short selling in the futures market and carry over. So technically, when you have short selling, the way it really works is I don't have the shares, but I will borrow the share from you and sell it. When it goes down, I will buy it back and give it back to you. That's how it should work. So there should be a borrow lending mechanism. But in India, we don't have it because SEBI has not allowed it. So that's why they let you do only intraday. Are you clear, students? Okay, you should be able to borrow the stock from the exchange, which will have a borrowing lending mechanism, which is not there in India. In America, it is there, but here it is not. Is that clear? So if there's a borrowing lending mechanism, the exchange will lend you the shares. They will borrow it from somebody, give it to you. You sell them. When it goes down, you buy it back. So normally that can be done only on margin. But what is the biggest risk of shorts? Unlimited risk is there, right? If the share price keeps going up, 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 after you sell, you lose a lot of money. You can lose unlimited amounts of money. Yes? So how is it a technical indicator though? So when the market is going up, yes, sometimes the market goes non-stop up like what we have seen post-COVID. There won't be any short sellers at all left. In that case, what will happen is since there are no sellers, suddenly when the market decides to correct and come down due to some reason, either economic news or something, it may come down quite a bit because there was no short sellers. Why is that? What do short sellers do? Once the market comes down, they start buying it back, right? So as a result, they act as a floor and support the market. So this is why I don't agree with SEBI's idea of not allowing short sales, because it's short selling will actually stabilize the market. Okay. So that's an indicator too. So if there is too much short selling though, if the market keeps going up and short sellers keep increasing, what will happen is the market may continue to go up and short sellers may have to cover and push the market even further. So this is another indicator that can be used very powerfully to understand the underlying trend of the market. Any questions, students, on what we have discussed? Okay. Moving averages are very, very important. Okay, students. In fact, we will talk about them in detail later in Nifty's context. maybe. So there are short term. So a moving average is simply the average of the last few days worth of price of the 10-day moving average, last 10 days average. Okay. 20-day moving average, 50-day moving average, 100-day, and so on. So short term moving averages would be 10-day moving averages, 20-day to 10-day. Intermediate would be 50 to 100, and long term moving averages, 200-day moving average. So in a bull market, prices will always be above the moving averages, trade above the moving averages. Whereas in a bear market, prices will always come below the moving averages. So this is something you must understand. So I will show you an actual example here. Can you see that? The moving average is actually acting as a support. This is Microsoft's moving average. And look, every time it crosses the moving average, one more thing, when the moving average is rising, usually the trend is up. And when the moving average changes trend, the price also starts falling. Can you see that? So that middle dark line is the moving average line. Yes. As long as prices are above it, it keeps rising. Once price break the moving average, the trend changes. Yes. So you can see small trend changes here, here. And then when the price goes above the moving average and it starts rising, trend goes up. You see that, students? Yes. Another way to look at moving averages, in an uptrend, okay, the short-term moving average will be higher, always higher than the long-term moving average. I will show this to you in a minute. In an uptrend, the short-term moving averages will always be higher than the long-term moving average. Here you see only one moving average. Later on, I'm going to show you a series of moving averages for the Nifty. We'll look at them and analyze them. Any questions on anything discussed so far, students? Okay. Oscillators. So oscillators are indicating momentum in the market. How strong is the underlying trend? Yes. So you can basically look at, is the trend very, very strong? So there are some oscillators. We will look at a few of them. So the most widely used one is RSI. Yes. So RSI is widely used. So RSI varies from 0 to 100. Every time RSI goes below 30, there is an oversold condition in the market, which may result in a short-term bounce. Please understand, short-term only. And similarly, when the RSI goes above 70, like what has happened to Nifty, it can probably result in some short-term weakness. But however, RSI can be used to detect divergence in the market. So what is a divergence? Price is going up, RSI is going up, that is a strong uptrend. However, when the price is making new highs, but the RSI fails to do that, then we have a divergence and there is a case for a trend reversal. Okay, I will show this to you in this Nifty chart. We are going to see in a minute. Okay. So this is how RSI looks for an actual chart. You can see when it is overbought, yes, corrections have come. But remember, you should use RSI in context of the trend. When the trend is down, if it is overbought, you can sell it. But when the trend is up, you are looking to buy oversold. Okay. So you can see this company. This is in a downtrend every time. So you can see something here. Anything you are observing? In a downtrend, RSI is always below 50. Okay, the RSI is an oscillator. It is used to detect, first of all, the strength of the underlying trend. When price and RSI are increasing at the same time, the trend is very strong. And when price and RSI are decreasing at the same time, the trend is weak or a bearish trend. However, when price goes up, but RSI doesn't make, when price is making a new high, but RSI does not do it, then there is a reversal of chance of a reversal. So here in this graph, you are seeing Any observations, students? Look at the uptrend and in the downtrend. What do you see? You can clearly see in the downtrend, the RSI does not cross 50 very often. RSI often stays below 50. But in an uptrend, when it is moving up, prices have stayed in the left-hand corner of the graph. When the price was moving up, RSI was above 50 the whole time. Yes, can you see that? But when price started declining, RSI stayed below 50. Every now and then it went above, but it came right back down. So that's the sign of a weak trend. RSI is also falling, price is also falling. However, under extremes, reversals happen. So when it goes below 30 and stays there, then reversals happen. Yes, students? Is that clear? Okay, fantastic. All right. Now, graphs. Graphs tell you all about the chart, the trend, underlying trend. Yes. So in a graph, which we just saw, basically your past prices and future price history is captured. Yes. And very, very, very useful to look at a graph. Okay. So the first type of graph is a point and figure chart. Okay. In this point and figure chart, we will only look at the trend. We will remove time from this graph. So prices are marked into a series of X's and O's. Series of X's implies prices go up. Series of O's imply prices go down. Have a look. This is a point and figure graph. There's no time stamp on this, right? So you can see when a series of X's form above the O's, then the trend starts going up. However, when the O's start forming below the X, then the trend starts reversing. So the O's are down movements in price, the X's are up movements in price. So this does not have date associated with it. So this is called a point and figure chart. Are you able to see the dots there? That is down price movement. The X's are up price movement. So the whole price movement is compressed. No time is put, exact time is put on the x-axis. Just the pattern. So you can tell if it is an up pattern or a down pattern or what is happening. So in this case, prices have come down and then now they are rebounding slightly. Yes. But unless the if now you have to watch the next few days and see if the O's go below the X's. If the O's go below the X, then a new downtrend, like what you see, 0.9 you see on the left-hand side. That was when the new downtrend happened. Prices went straight down, right? So you should look for that. O forming below an X. That is all you can do with the point and figure chart. Any questions, students? Is that clear? Okay. Bar charts. Okay. Bar charts are the ones we saw so far. Yes. You can use just plain bars. Increasingly, a lot of people are focusing on candlesticks. I don't pay much attention to candlesticks because there are too many false signals based on it. But every now and then, the obvious green or red candle can tell you something. Okay. So bar charts again can be used to look at the trend. Okay. And then some chart patterns. Yes. So chart patterns can tell you where the trend is headed. Okay. Okay. So this is a bar graph. So the red bars are showing downward price movement. The black or blue bars are showing upward price movement. When a red bar forms below the black bar, usually the trend changes. And similarly, when a black bar suddenly goes above the red bar, maybe the trend can change on the upside. So have a look at this. You can see the clear movement up. So in the left-hand corner, the price was going down a little bit, and then a black bar formed, and then it went up. So when the next red bar formed below the black bar, it went down, and so on and so forth. You can see that, students? Yeah, great. Any questions on anything discussed? All right. Okay, now, um, you have all studied something called the efficient market hypothesis, EMH, in your SAPM. Yes, students? Okay, so the efficient market hypothesis says that basically markets are efficient, which means you cannot use past prices to predict future values, meaning technical analysis won't work. So this is why you have to use technical analysis only in addition to fundamental analysis. So there are some interesting technical patterns that may or may not work. Okay. So, but for now, just let's look at a few that are very widely followed in the industry. Okay. The first one is the head and shoulders. Okay. You see a head and a shoulder. Yeah. You can, head and shoulders pattern is basically a bearish pattern. You have price making a small high, then it makes a bigger high, comes down and makes another smaller high. So the smaller highs are your shoulders and the main high is the top. Usually that line that connects the bottom is called the neckline. When that neckline breaks, prices go down. So that's a bearish pattern. However, the inverse head and shoulders is the reverse of this and it's very, very bullish. Okay. Can you see the pattern? So this is how it looks. I'll show you an actual graph now. Can you see that pattern there? Head and shoulders. Yes. So when prices break down, often they will come and test that neckline again. That straight line you see there, that one is a neckline. When prices break that, you'll get big downside. Sometimes prices will come back, test the neckline, which will act as resistance, and the downside will continue. The downside target is usually the distance from the head to the neckline. So till that, you can confirm get downside, sometimes even more than that. So that is a head and shoulders. You can see it, students, on that graph. Yes. Very good. Next, the double or M top and a double bottom or W bottom. So when you have a double top, prices make one top and the next top is very close to the previous top, but it cannot exceed it convincingly and the prices come and crash. And a target for that is that. Similarly, the reverse of that is a double bottom. Prices don't make newer lows. They make one low, they retest it and move higher. So that is called the double top and double bottom. You're able to see that M and W? So let's look at an actual chart. Can you see the W bottom here, students? Yes? Very clear, right? So the top of the W is where you can price target. Sometimes it exceeds it. In this case, it has exceeded it. It will make a perfect W if it's bottoming. Similarly, if it's topping, it will make a M. You could argue here also on the left-hand side, there was a small W, right? But this one is more clear. Any questions, students, on anything discussed up to now? Okay. Okay. So once we go through this, we will go to some live examples and you will actually apply some of these concepts. Okay. Next, we will look at triangles. Okay, we will look at ascending and descending triangles and symmetrical. So prices can be remain in a triangle formation where the top of the triangle is resistance and the bottom of the triangle is support. Yes. So when price breaks out either at the top or at the down, yes, you will get very big price movement. So triangles are very useful to see. They are very, very, very useful patterns because once price breaks out of the triangle, you can get very big moves. So ascending you can have, descending, or you can even have a symmetrical triangle, which is neither ascending or descending. See that picture, students? Yes? Okay, now let's look at some situations. Okay, before that, rounding top and rounding bottom. Another very powerful technical pattern. A rounding bottom happens over time. It doesn't happen in 1 or 2 days. Well, sometimes in the hourly chart it can happen. But when prices make a rounding bottom, it can make a lasting bottom and it can move up from there. Okay, you see the shape? It's a circle. Similarly, rounding top can make a lasting top. Yes. But it happens over time, this pattern. Can you see the rounding bottom here, students? Yes? Yeah. So that's how the rounding bottom looks like. Happens over time. Ultimately, prices don't go back to the previous lows. But remember, technical graphs are only patterns. Okay? And patterns happen over time. Sometimes they don't work. For that, you have to keep something called the stop. Okay, broadening formations are your extensions of triangles. They are very much extension of triangles, but they are like reverse triangles. So they are almost looking like a loudspeaker. So you have higher tops, but higher bottoms. So the US market is making something called this. And usually when it breaks out on either side, it is right now the top of that. But if it somehow reverses, it can come all the way to the bottom, and there's a very big distance between the top and the bottom. So these patterns can be very powerful and happen usually over years. So you can usually see trend reversals happening with these patterns. You can see the loudspeaker shape there, students. Yes? Yeah. Okay, now tell me what are the patterns you see here? There are many patterns. Come on, let's see how many you can spot. Take your time. I'll give you 5 minutes. Double bottom. Okay, there we go. Yes. What else? Triangles. Yes. Anything else? Inverted head and shoulder. Yes. Anything else? Inverted head and shoulder. Yeah. Oh, you see a flag. I didn't talk about a flag, but flag is also a bullish pattern. You can see an inverted flag here towards the end of the graph. So a regular flag like chart is a bullish pattern, but an inverted flag like this is bearish. Triangle. Yes. 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 What else, students? Double top. Yes. Possibly head and shoulders also. Yes. Yes, students, anything else? So let's see. You call most of them. There's something called gap. So sometimes prices may open much higher or much lower than the previous day. That creates a gap. So usually after some time when prices rebound, they will come and test the gap. The gap will act as resistance. But you can see channels and support triangles, double bottom, descending triangles. Yeah. So that left-hand side channel, rectangle channel, is just support and resistance right there for you. Yes, students? There you go. Okay. Now, I would like to know, any of you guys are trading with the trading in the market? First day, many of you said you were trading. Now tell me, what indicators do you use? Okay, I'm going to go to switch screens here, and I'm going to go to live market here. Okay, before we get there, uh, okay. Okay, in fact, MACD is another technical indicator. It is my favorite. I'll show you in a minute. So this is our Nifty chart here. Up a lot today, I think. Oh, not as much now. It was up earlier, quite a bit, little bit more given up. 850 it was. Okay, so this is the Nifty.
So,
Yes.
yeah, so we can't see the charts and all.
Oh, sorry. I didn't share the screen. I forgot. My fault. Okay, let's look at where is the share screen option? Oh, there we go. Are you seeing the browser now? I can't move this top line.
Yes, sir.
1 minute. I'm trying to, from yesterday, trying to drag and drop this below, but the thing is covering my browser. Or maybe it'll help me. If I can drag it. See, I can't click on my Windows. So. Okay, I'll just stop sharing this. Okay, now I will share. Why would not my screen come up? Okay, this is what I want to share. 1 second, students. I'm still figuring this out. Little technologically challenged here. There we go. Okay. So, Control C. I'm going to share this with you, students, this link. Have a look. You can just click on this. Yes. So let us apply some principles here of technical analysis, which we have just learned. Okay. So this is, so in this graph, just click the leftmost thing, you'll get candles. Yes. So you had a bearish candle yesterday. Just for now, think of it as a bearish candle. Okay. Click the middle indicator Yes, and bring up MACD. This indicator is very much like your RSI, but this is an oscillator which is called moving average crossover divergence. Okay, so when you are trading, this indicator comes in handy. Why? Let me tell you. So look at this. Despite the move up, you are seeing the blue line, which is a short-term moving average, cross below the red line. Yes, when this happens, usually a bearish trend will start. However, when the blue line crosses above the red line, very big bullish trend will start. So that is number one. So according to MACD, bearish. Now, one more indicator I will give you. Just click on the indicator and type in BOLL, Bollinger Bands. Okay. Have you got that, students? Yes, students. Are you seeing it? Students, did you see that? Okay, fantastic. So the Bollinger Band is two standard. The top blue line is two standard deviations above the 20-day. The red line is the 20-day moving average. Two standard deviations above is the blue line, and two standard deviations below is the lower line. So we want, here is the deal. We want to place a trade. If we are betting things would go up, we want MACD to be positive, which is not. Look, MACD is negative, right? Minus 46. Students, are you seeing this? Students, yeah?
Yes, sir.
MACD is negative. So in this case, price, if MACD is negative and we want to make a bet that price is going to go down, we want the price below the red band. In this case, price is above the red band, right? So it's not a short for us. You cannot sell this. Can we buy this? Price is above, but MACD is negative. So no. So this is how you filter. Okay. Now let's look at something which will work for us. Let's look at Coal India. This one is very bullish. Look at the MACD. But MACD is getting ready to cross, but MACD is still bullish. Price is on the half, but you have to be very careful if prices reverse like this from the top Bollinger Band. They can suddenly come to the lower Bollinger Band. But this stock to me is a buy if it comes somewhere near 170. Yes, because it is very overextended and it has put two red candles in a row. It may give some kind of correction. But this is a bullish chart. Don't get me wrong. MACD positive and price is above the middle Bollinger Band. You see that, students? Ideal time to buy was when the MACD crossed. Right here, if you had bought from 140, you would have wrote 50 points on this. Excellent, right? Now, remember I told you, is there a fundamental reason to buy this? Earnings yield, if you do calculations, it is definitely one of those stocks that qualifies. So when a stock qualifies fundamentally, I will look for buy entries. And if it somewhere comes near 170 range, so, and it touches the lower Bollinger Band and we still have MACD positive, then it's a good buy. Okay, now let us look back test this strategy and see if it would have worked. Let us look at another case. Here, sell signal came. Price broke the Bollinger Band. When? Here, 151 and came all the way to 130, right? Yes? So always back test your strategy. Yes? And for everything, there is risk and reward. Yes? Okay, tomorrow is something important happening. What is happening tomorrow, students? That can move the market one way or other. Tell me, students, what is happening tomorrow that can move the market one way or other? There are two main things, one global, one local. Yes, students, type in the chat, please. Yeah, RBI interest rate the decision is the local. What about the global one? So, no Federal Reserve tomorrow, but US jobs report is there. It will come at 6 o'clock our time. So, why is that important? I think the US jobs report is more important than the RBI rate decision. Can any of you expand on this and tell me why? Yes, students, anyone? So tomorrow's job report, if it is very strong, yes, then if the job report comes very strong, remember the Fed has been buying a lot of bonds. They may start reducing the asset purchase. Yes, taper tantrum is correct. So they may have to reduce the asset purchases somewhere down the line. They've already said they are going to, but it may come soon. Remember, asset purchases and stock prices have been directly correlated. And if that is the case, suddenly the dollar could become strong. And if the dollar were to become strong, then all bets are off. Suddenly money can go out of all these emerging market countries like India back to the US, and we could get a sell-off. Very possible that that can happen. Yes, so markets could have a taper tantrum, as somebody put in the chat box. That's what it's called. RBI, we should, what should we look from the RBI? What do you think the RBI will do tomorrow, students? If you were the RBI governor, what would you do? Yes, students, what would you do if you were the RBI governor? Remember, the RBI did something called Operation Twist, where they were also buying a lot of government bonds, right? Okay, already raised the interest rate, you think? So that's the debate, right? So what is RBI's inflation target? What used to be RBI's inflation target? 4 to 6 actually. Originally it was 4%. So now the inflation is running at 5.5. So it's high. Recently RBI came out and said it's okay if inflation stays with 4 to 6%. But they may come out and say inflation is going to eventually go up. We may have to reduce asset purchases. And in that case, what will happen is markets may not like it, bond yields. But interestingly, RBI was doing asset purchases to keep bond yields down, but bond yields are above 6.15%. So bond yields have not followed the script. Okay. So that is something. And the rupee also has been weak of late. So if RBI says they are going to buy more asset purchases, then what will happen to the rupee? It can get more weak. And if it gets more weak, inflation may come somewhere down the line, right? So this is a fine line the RBI has to walk tomorrow. My guess is they won't do anything. They will keep the repo rate at 4% itself. Yes. I think somewhere next year is when they will start hiking rates. Okay, students. Now, going back to subject. Now, let us say we think Coal India is bullish and we want to buy this. Okay, you tell me. Yes, how can we come up with a strategy? Okay, what is the previous high in Coal India? It is about, recent high is about 203. Okay. So what is our risk here? Our target 203. How much of that is the upside? About 6%. From 191 to 203, about 6%. But what is our potential downside, students? Yes. What do you think our downside is? Possibly. Maybe at least till here. 183. Yes. Okay, so 183, 190 to 183. So 183 is where I will put my stop loss. A stop loss is a point which takes me out of the trade if it goes against me. So if I'm buying here, I'm going to put a stop loss near 183. Okay, students. So what is that? How much percentage below is it? Around 4%, right? So 6 by 4, 6% upside, 4% downside. 6 by 4 is 1.5. So my risk reward ratio is 1.5. Are you understanding? If I'm buying at 191, 191 to the previous high near 203 is 6%. 191 to the recent low near 183 is 4%. 6 by 4 is 1.5. Is that good, students? Risk reward is good for you, you think? I don't take trades unless it is 2 to 1. If you have a 2 to 1 or higher risk reward, then it is a safer trade to take. Okay, now let us look at something else. What do you want to look at, students? Any companies? Any companies, students? NMDC, okay. Okay. Now this is a case where the trend is bearish. So if I am taking a trade, I am looking to sell this, right? It is touching the red line. So my upward stop loss 145. Where should I put my stop loss? Remember, I'm selling here, not buying. So stop loss should be above. So I will put my stop loss at 156 or something like that. 155, the top Bollinger Band. So what is my risk here? Nearly 7%. What about the reward? It can come to 135. So that is 7%. Is that good, students? 7 by 7. Not very good, right? One risk reward is 1 here. Yes. But if it comes to 135, maybe you revisit the stop loss. But this is bearish. You understand how to calculate risk reward, students? Very, very important in your trading. Just don't randomly trade. Always understand what your target is, what your stop loss is. Based on that, calculate your risk reward and then act. Okay, any other company, students? I want to put you into your breakout rooms and I want each group like yesterday to come. CDSL, okay, let's look. One second. Okay. CDSL price is sitting at the Bollinger Band. It has come from above. Okay, tell me, students, will you buy this or will you sell this? What do you think? What do you think? This is tricky. Price was in an uptrend. Now it is coming to the bottom. So if I'm buying, my stop loss would be the lower Bollinger Band, 1290. And it could go all the way to 1380. So 1290 from here is how much? Somebody do the calculation. 1291. What do you think? Somebody do the calculation and tell me what the risk is. I'll put my stop loss here at 1290. I think we can try and buy this. You can either, because the upside risk reward is a little bit higher. So tell me what the risk reward is, students. Assuming I'm buying this. Almost 5% upside and 2% downside. Good risk reward if you are thinking it goes up. Yes? Students, are you understanding this concept of risk reward? Very, very important. Please do not trade without risk reward calculations. The reason most traders lose money is they always work on the reward but fail to understand the risk. Yes? Do these risk reward calculations before making trades. Okay, for a change, let us look at the USD INR currency. This one is finding resistance at the top of the Bollinger Band. So I would not buy this definitely, but I wouldn't sell it either because it may still go up. So where would I buy this, students? Tell me. Where should I wait to buy this? In fact, I've been waiting, and it's not coming. 74, right? 73.97, you see that? Middle Bollinger Band. Yeah, exactly right. 74, I've been waiting. It's been going non-stop up. Okay. But the signal was when it crossed that red Bollinger Band, you should have picked it up. I got stopped out, so I re-entered that. I should have re-entered the trade, but hey, it ran away. If it runs away, it's okay. You don't chase it. Right now, not much good risk reward is there.